Good afternoon, ladies and gentlemen, and welcome to the Van ELLE interim results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via vanelle@walbrookpr.com. The company may not be in a position to answer every question it receives during the presentation. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, I would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive Mark Cutler and Chief Financial Officer Graham Campbell. Gentlemen.
Afternoon, everyone. Okay, we'll run through our investor presentation as delivered this morning to institutional analysts as well, exactly the same document, and give plenty of time for questions at the end. If we can just go to the overview section, I hope you can all see that. We're pretty pleased with performance in the first half, resilient performance in the face of very challenging market conditions. You'll be well aware that the construction industry is suffering a little bit from inflation and difficulty sort of getting momentum in terms of investment confidence in several sectors, and affordability issues and high interest rates around projects in pretty much all sectors. And we expected this when we set our forecasts and budgets for FY24. So revenues are down as a result of that, and we've benefited from being as diverse as we are across housing, infrastructure, and construction in terms of making progress in terms of the work that we're able to bring through. Margins have been maintained broadly in line with last year. Underlying that, our gross margins are up, which we're pleased with. We're still seeing wage inflation and some cost inflation, but we're generally quite successful at passing that on through our contract mechanisms. No particular issues around getting caught with fixed price deals or cost inflation that's given us any commercial issues on projects. A very, very clean operational performance in the period. So that's left us with operating profit of 2.7 million, and as I said, 3.9% operating profit margin. This year, I think, very much is one of it's always going to be a flat performance. Our forecast is a touch lower than it was last year. As you'll be aware, we're holding that full year forecast, but we're itching to make more progress. We'll be making more progress as soon as the markets improve and give us some momentum in the sectors that everyone's familiar with: housing, rail, highways, and the construction markets. But we've also been pressing hard on diversifying further in the UK with energy and water, and also in terms of rail in Canada, which we'll touch on a little bit later. And we see tremendous potential in all of those, actually. Cash position is improved. Our net funds position is improved. Our balance sheet is very strong. We are a very safe bet for the tier one blue chip customers that we focus on, and we have the headroom to do more in terms of acquisition and capex to support growth going forward. So very, very stable financial position. And we've made a couple of comments on the front page about Canada, just to be ultra transparent. First of all, it's taken us longer to get started than we expected, and I'll come on to that a little bit later when we get to the rail section. But we're sustainable, through the turn of the year. And we're gonna take our time just to review, given slippage on some of the bigger programs we're targeting, how we want to make the best of our resources in the next planning period. And also, we've pointed out that we have an increasing and recurring upside from research and development expenditure credit, RDEC for short, where we've reported an increase in the contribution in this period, which we should be pleased about, because that reflects the innovation that we're putting into the sorts of products and services that are going to fuel our growth. And it's something that we expect will improve consistently going forward as well. Those two items broadly net off actually in the period. And we've confirmed the interim dividend, which is not out of kilter with previous announcements. Graham.
Okay, thanks, Mark. So quick rundown as usual down the P&L and balance sheet, and then a quick canter through the three divisions or the segments that we report against. In terms of the income statement, as Mark said, a drop off in revenue as we expected, with a very challenging set of end markets. Not least, you'll be familiar, I'm sure, with the current level of new build housing. If you've read any of the house builders' recent announcements, that is certainly a challenging sector that we expect to continue through certainly to the end of the financial year. Particularly pleasing is to see the improvement in the gross profit percent. We've talked about this again in previous presentations, and this is, I suppose, twofold really. One is the improved mix of our workload, so higher volumes of work at the upper end of our margin range. That's typically within, you've seen rail, strata, and some of our infrastructure works have delivered well there. And of course, with the drop off in housing, which is at the lower end of our margin range, that balance has been slightly redressed back to, so we're pleased to deliver just over 30% gross profit margin. We are certainly still facing inflationary pressures on our costs. We've got a cost management committee. We're looking very close at our costs and what we can do to reduce them. But inevitably, as you will have read, I'm sure, across the market, wage inflation is still running high. We've got in 2022, we saw across the year around about 10% wage inflation, and 2023 calendar year, broadly 5 to 6%, around that sort of level. So you'll have seen, of course, the inflation numbers published, and that is impacting us. It's hitting us hard, but we're looking at other efficiencies to manage that cost base as best we can. The other thing in terms of the flow through here to the profit numbers is, in previous years we had a couple of challenging jobs, and this is a relatively clean set of results. So if you were to wind back to a previous RNS from the previous year, you would see comments around challenging jobs, lower margins, and actually our operational delivery has been excellent in the first half. Much fewer issues on jobs. We've closed out 2 of the largest jobs we've ever delivered as a group. We've closed that out successfully with the customer. In terms of EPS, just very briefly, we've taken a prudent position on booking at carry forward losses for the setup of the Canada business, and what that means is we effectively haven't booked a deferred tax asset in the balance sheet, and therefore it impacts EPS. So I suppose on an adjusted basis, it's a bit easier to read that. If you think about the impact of Canada short-term losses and the prudent position we've taken on that, you could have the adjusting element is about 0.6 pence on top of there. So arguably on an adjusted basis, EPS true rate is more like 2.2 pence compared to the previous year of 2.6. 3 divisions. I'll start with general piling. You'll see there clearly general piling's revenue down 13% period on period. What we've seen here is growth in residential and infrastructure, but much reduced levels of commercial construction projects. And we had a very strong comparative period in that sector within general piling. The sector itself remains, as always, it's very competitive, and therefore by the nature of that, it becomes very price sensitive. So the team working very hard, lots of good opportunities in the pipeline, but off the back of last year, where we had a brought forward order book with significant projects in there that were delivered during H1 FY23. We had a lower order book brought into the current year. So just softer markets overall, I think, within the general piling division. We acquired Rock and Alluvium on the 30th of November, which we're particularly pleased about. It strengthens our presence in the southeast. You'll have seen the order book increase overall, and particularly attractive there is Rock and Alluvium bringing in just short of 12 million in total orders. Market is still challenging in the southeast because they are heavily exposed to the residential sector. We're starting to see some improvement in the market there, and that's reflected in their very strong order book. Of course, we'll touch on this a little bit later, but associated with that Rock and Alluvium acquisition is the 5-year trading deal with Galliford Try, where we will support them with piling works over the next 5 years. The second of our segments is specialist piling and rail, and that is a very mixed story here. Overall, the revenues are down period on period, and that's reflected in the lower operating profit. What's particularly been hit hard is the specialist piling division, and that has operated near capacity until 2023, the beginning of 2023, when volumes dropped off. Much softer market conditions. We always thought that would be a short-term dip, but what we've seen towards the end of half two is, despite the weaker performance in half one, we've seen very good order winning just before the beginning of half two, and the division is now operating at pretty much capacity. So we're expecting a much improved performance for specialist piling in the second half of the financial year. Rail is a slightly different story. Rail has benefited from the final year of CP6 and has been very busy in the first half. How this sector looks moving forward, and Mark will touch on this in a bit more detail, but as we exit CP6 and Network Rail goes into the planning period for CP7, we will inevitably see a drop-off in activity. We're already starting to see some of that. But the next bullet point is key, which is that we're on frameworks for the Trans-Pennine route upgrade, and we expect that to provide a base load of work through 2024. So as we see the dip between the control periods, we expect Trans-Pennine route upgrade to step in and fill the gap. Mark's touched on Canada already, so I'll move on. Ground engineering services, for those that have watched these presentations before, this is effectively sort of 80 to 90% of our housing division, and then approximately 7 to 8 million or so of Strata, which is our ground investigation division. I mean, look, no surprises here probably, given that the volumes are off 17%. Demand for housing was extremely strong in the first quarter. Very, very busy. We're very pleased with the performance in the first quarter, not least because there were new building regulations coming through in June, and we saw a bit of a hiatus of build-up of work before we saw the decline in the second quarter. But as expected, and as many of the house builders are talking, we've seen that decline in workload in Q2. It's continued into Q3. We expect broadly the same in Q4 before a steady market recovery. Our current view is that the dip may not be quite as severe as some commentators were predicting a few months ago. Strata, very little to say. It's going, the division's going very well. It's at the upper end of our margin spectrum. Revenues are growing, and we've made really good progress on a number of infrastructure fronts, not least in the highway sector and on some HS2 ground investigation projects. And the balance sheet, well, I think we're in a good position. We've continued to invest in rigs and the group's transport fleet. The net capex in the period is 2.5 million, but the story behind that is that we've actually invested 3.9 million of capex, and we've focused on high utilization, higher margin, higher return on capital rigs. And we've offloaded and disposed of a number of the lower utilization elements. So, for example, we've had a close look at our HGV fleet. We've kept what we think is the optimum measure to operate our internal transport fleet as effectively as possible. and so that gives us a net 2.5 spend, but the underlying investment in the business is close to 4 million. A slight decline in working capital, as you may expect, with a reduction in the activity levels. And in terms of cash, we're in a net funds position, which is I think a fortunate position to be in at the moment, given the way that the construction market is. We've increased cash, we've reduced debt. We paid off at the beginning of the year 2 of our largest hire purchase contracts. So by the end of the period, we're sitting with just short of 100,000 of debt, so effectively an insignificant debt level. We also paid the final settlement for the acquisition of Screwfast. That was just over 700,000 in the period, and of course the final dividend payment as well. So broadly, I'd say I'm very satisfied with where cash is at. We're sitting with 9 million of cash on the balance sheet at the end of the period, and we have an 11 million funding facility, which is undrawn. So I think plenty of liquidity headroom, which is a good stable place to be. And there it is in terms of net funds. So again, there's not really too much to add to this. You can see there very clearly cash at the end of the period, 9 million, and the 100,000 I just mentioned in terms of our remaining HP debt brings us down to the 8.9 net funds position. Mark, could I hand back to you to wrap up?
Yeah, so in two points here. One is the short-term trading conditions are likely to remain challenging until the end of the financial year. We all know that the housing market is going to take some time to come back, and there are spending constraints in infrastructure, not least because of the Department for Transport's budgets are affected by HS2 and the change in control period in the rail sector. Highway spend is also sort of carefully being controlled at the minute as well. But we are seeing opportunities to make further progress in Q4 ahead of ramp up in FY25. And as we said earlier, we can offset some dips with other opportunities already with us, such as the frameworks that we have on Transpennine route upgrade. The smart motorway framework will commence in Q4, and we've got a very good workload in specialist piling coming through as well. We're seeing early signs of the housing market already coming back, and so we think we're past the worst of the dip in housing, and we can see an uptick in inquiries and orders for projects going in towards Q4. I think it gives us confidence further afield into FY25. So we're confident in terms of our full year forecast. We're holding it. We've got contingency to allow us to have further delays and setbacks if we need to in terms of projects proceeding. Because a feature of the industry is delays and re-tendering and affordability difficulties. But interest rates are stabilizing, as we all know, inflation stabilizing, and we do sense that is giving a general sign of more confidence around the industry. And so going into the medium term, FY25 and onwards, we're very, very confident around the possibilities. In fact, we think certainties of growth that we've been talking about and have seen flashes of over the last few years starting to come to fruition, along with our customer work and business development work to diversify ourselves sufficiently and position ourselves in high margin niche areas that benefit from sustainable, less cyclical investment challenges. And that's why we've been working hard on the power sector, high voltage power sector. So this is transmission and distribution infrastructure. I'll come on to a bit more detail in a minute. Also in the water sector, where we've been making progress, particularly with our partnership with Galliford Try, who are particularly strong in water. That was part of the thinking of that deal. We have rock and alluvium helping us with a geographical spread, and particularly the southeast, where we're seeing early signs of the commercial and residential markets coming back, more quickly than the rest of the country already. And it's no accident really that rock and alluvium's order book is proportionally quite strong compared to the rest of Van ELLE at the moment. We think London and the southeast is coming back quite well. And just a quick word on the Galliford Try trading agreement. We see significant opportunity here. We've modelled 10 to 15 million in the first full year of trading here, of incremental revenues on a partnership basis. It's not an exclusive arrangement with us. We'll have to perform, but we are partner of first choice, and that means that we're embedded with Galliford's and helping them win projects and engineer them efficiently, and we'll become a very dependable team for them. And I think it's as good a deal for them as it is for us. So that all of those things combined give us significant prospects to improve over and above the natural recovery of rail going into CP7, and the wider housing and construction markets that we've touched on. So as far as we're concerned, and our forecasts are out in the marketplace, there's no reason we shouldn't be doubling our profits in the next 3 to 4 years. Absolutely no reason at all. You'll see forecasts out there for FY25 and FY26. We'll be disappointed if we can't beat those, as you would expect. And perhaps with a bolt-on acquisition every year or so, we can boost our speed of progress, and that's certainly what we're focusing on at the moment. Just a quick further word as well about Canada, because it is important to just explain, because we do see significant opportunity in Canada. And although we've spent the first half of the year investing in our setup, we set up a very professional capability in Toronto. We've got a top team over there. We've trained our workforce, we've shipped our rigs, we've made the adaptations for winter working, we've got the necessary certifications all in place to work on the Metrolinx network, sponsored by a strong set of tier one contractor customers who are glad to have us on board. And we're starting to see workload flowing through quite impressively. We're in a sustainable trading position as we speak now, and we do expect to make further progress. But because the On Express program for Metrolinx has been delayed, it's been announced, been delayed a couple of years, possibly up to a couple of years, we are going to take stock and review, what we need to do here to make the most of this opportunity, and is this the best use of capital, and was the original plan still the very best plan? And we'll do that by the end of the financial year. But the opportunities are significant and certainly flowing through faster than we're seeing in terms of the UK rail market, which is what we'd hoped for. And just a couple of slides just to put a bit of colour on the two exciting sort of newer growth segments that complement all the other sectors that we work in consistently and have done for some time. I've mentioned already energy. The customer base here is as below. We have frameworks in place with Morgan Sindall and Wood and Freedom, actually part of the NG Bailey Group, and commitments that we're going to support Murphy and Keltbray. These are all established tier one contractors in the transmission and higher voltage range of the distribution network. And we're looking here at eye-watering investment levels to deal with grid connections, aging infrastructure, and energy security, all being pushed along by Ofgem and the and the big energy transmission companies. And we expect to see our first projects on site for Wood Group and possibly Morgan Sindall as well before the end of FY24, and it will grow significantly from there. We're looking at huge investment areas. And the major concern in this sector is the capacity to deliver everything that's got to be done. And at the same time, we're pushing on water. And this is, as I say, propelled to some degree by our partnership with Galliford Try. This is part of the rationale. Galliford's are the leading water infrastructure contractor in the UK. but also there's some good household names on that page where we're also in a very strong position. Two of them are on the previous page, so that's quite helpful. They tend to be the same management teams in some cases. And we have, we're spending 5 years now working on closer customer partnerships, which is starting to yield frameworks and repeat business and a level of trust with us as a business that we can support through our breadth of capability, our scale of resource, strength of balance sheet, all the innovation in our techniques and processes, evidenced by the RDEC point earlier, and innovation like Screwfast, for example, which is the sort of stuff that is very, very helpful indeed in these sectors where you don't want big piling rigs and great big sort of temporary works and all the rest of it in the traditional sense. And this is further supplemented by a new division that we've opened, which is only small at this stage, but capable of doing quite a lot of work quite quickly, which is our civil engineering division, which complements our foundations and piling divisions very nicely, because we're finding customers want us to do ancillary and minor civil engineering work around the foundation and piling works that we do, sometimes taking away attendances that they might have provided for us and doing it ourselves, making life more simple, reducing the interfaces. And we started doing this in rail 2 or 3 years ago for obvious reasons. You don't want multiple contractors on track getting in each other's way. If you can avoid it, it works very well. The rail market is relatively niche compared to the opportunities in water and energy, where this model is being very, very well received. We're the only people doing it, and we're the only people with the breadth of geotechnical and piling capabilities that we've got as well. So it's a good combination. So that's how we're going to fuel our growth in these high margin sectors through these frameworks. And there's a page of statistics there, really more for reference. They probably tell the same story, which is, it's been a challenging first half of the year compared to what we're expecting ahead of us. But we're in good shape.
Super. All right. Thank you. Thank you, Graham. If we could turn to the questions, we had a number submitted ahead of the presentation, and there have been plenty during it. Mark, if I could just turn to you, quick terminology question. Eric asks, we talked about a bit, CP6 and CP7. He said, what is meant by CP6?
Oh, apologies. Control period 6 and control period 7. These are the 5-year investment periods set by the Network Rail and the department for the funding settlement that Network Rail spend on its infrastructure.
Great. Okay. And the second question from Eric, which is on the Canadian subsidiary. How is the Canadian subsidiary being managed, and how are the local managers being held accountable?
Okay, so the Canadian subsidiary is managed by a local regional manager, a Canadian chap who is very well embedded with the marketplace, and supervised by 2 directors who alternate their time in Canada, so that there's full-time support. And those guys report to me, and we're all accountable.
Great. Okay. There has been much commentary on the health of particularly smaller construction companies. What is your experience? And I guess this also plays into the supply chain as well, if you could just add a bit on that too.
Yeah, so we've seen an increase in trade credit risk, as you might expect with construction companies, going out of business left, right and centre in the industry. A lot of people caught by fixed price contracts, having to absorb significant inflationary cost increases, not being able to, with nowhere to go really. We took out last year trade credit insurance for the first time as a business, and that's proved to be a good decision, and has helped us in a few situations where otherwise we'd have been self-insuring effectively, and we'll continue to do that. We're pretty. I suppose I don't think I should apologise. We're quite difficult to get into contract with people that we have any doubt about their stability and creditworthiness, and we negotiate hard and usually get the protection and security we need, or we don't do the work. So that's how we manage the upstream. Downstream, We self-deliver almost everything, so we're dependent on very few subcontractors, only occasional very niche things, and also big blue chip suppliers of our bulk raw materials such as concrete products and reinforced steel and the like. And we have a strengthened procurement team who have strategic arrangements in place with those who are big enough and capable enough to deliver our needs and stand by the commitments they give us. So I think we're in much better shape actually up and downstream as a result.
Great. Okay. You touched on this earlier, but I wonder if you could just add a little bit to it. But what are you seeing in the rebound on housing demand, and will that contribute to H2?
We're not expecting a huge contribution to H2 from a rebound in housing. We'll be quite happy to deliver the forecast that we've got, which is broadly break even in housing until things pick up. We've retained the capability very well and downsized to an appropriate level without sort of shooting ourselves in the foot for when things come back more strongly. I do expect the housing market to offer increased work volumes for us though before the end of Q4. But I'm not relying on it for our results. Certainly in FY25, almost certainly it'll be a fair bit better than what we've seen in the last 3 quarters of FY24. So we will be forecasting, I expect an increase in, when we get to a budget stage, an increase in housing activity in FY25. All the indications are there. So our forecasts for next year are out in the marketplace broadly 6.5 million PBT. That will come, but housing will certainly help that increase, as will all the other things I described earlier.
Okay. And on a similar theme, Douglas says, I'm expecting some economic optimism to return after the general election. If demand increases, how fast can you ramp up capacity?
We can ramp up pretty quickly. We've got 130 rigs, and utilization on that stats sheet, as you'll see, has room for significant increase. And we employ 450 people out in the field who are desperate to be even busier, and we can resource up as well. So we have a direct employment model that works very well. You might think it's difficult to reduce, but we have stand down arrangements in our contracts that the lads are comfortable with. But we can also recruit up pretty quickly. We're quite good at it. We have the ability to ramp up quite quickly. We rarely hire rigs, for example, but we can do, and we can bring in more labour. The overheating in the market has dipped a little bit now that HS2's phase 1 geotechnical works have started to ramp down. So we can pick and choose, I think, a lot better than maybe a couple of years ago. Good people at more affordable rates than the overheating that was taking place at that point in time.
Great, thank you. Right, some financial questions for you, Graham. Actually, Konstantinos says, can you please provide some more details on free cash flow generation, which looks slim historically? What is maintenance and what is growth capex, and what maintenance capex should we assume going forwards? A few questions in there.
Yeah, no problem. So look, I think that's a very good comment. Free cash flow has been relatively slim for a number of reasons. Obviously, we've got the challenging pandemic period to take into account, but also if you were to wind back 6 years, you would find that the group was carrying sort of 18-19 million of debt. So a lot of our debt servicing costs have gone into to drain our cash flow. And if you sort of look at the fact that we are firstly a capital intensive business, to Mark's point, we've got 130 owned rigs, a lot of those taken on hire purchase deals at relatively high interest rates in the past. That has drained the majority of our cash. How do I see it going forward? Well, if I look at the operating cash flow at the half year, 6 months, we're looking at just over 6 million, a modest shrinkage in working capital. And then if you look at the sort of the net capital spend there, we're at 2.5 million, as you were seeing from the presentation. And we've got the last of our repayment of our hire purchase deals in there as well. So about 2.3 million of hire purchase payments. We obviously have the M&A activity on Screwfast that I mentioned, and then the dividend. So you take all of those into account. Cash is relatively flat period on from the end of April to the end of October, but you can sort of see where the operating cash flow has been utilised. Obviously, I'm expecting the repayments of long-term leases and hire purchase to decrease and improve our cash flow overall. We also have a relatively modest dividend payment. We have not published yet a formal dividend policy, but at the moment we're sitting at the upper end of our sort of normal market sector. For our sector, normally 2 to 3 times dividend cover is pretty normal, and we're sitting at the upper end of that range. So it's a relatively modest dividend payment. In terms of what should you expect for CapEx going forward? Well, firstly, maintenance. I mean, clearly our depreciation is around sort of 5 to 6 million. I would expect at the very least that to be spent. We see lots of opportunities here for rigs in niche areas where margins are high and utilization should be high. So we're very much focused on return on capital and high utilization for our kit. And in terms of growth CapEx, a good example of that would be the acquisition of Rock and Alluvium, where with the acquisition came 11 new or relatively modern CFA piling rigs, and that will allow us to dispose of some of our older fleet and have a sort of best-in-class fleet in CFA piling.
Right, okay, thank you. And Konstantinos also asks, any comment on capital allocation strategy and M&A would be appreciated.
Well, I can take the first part of that, and then Mark, you may want to add something on M&A. But we have not published a formal capital allocation strategy, but I think I've covered off the key points there. In terms of where does our money go? Well, operating cash flow is invested back in sustaining the fleet. We must keep that as a modern fleet that's market leading, and we've got the largest fleet of kit in the UK, and that must be maintained, but it needs to be maintained in the right areas, which, as I say, is high utilization, higher margin activities. Dividends, I think, will remain relatively modest while we have that level of capital requirement. And another key point here is that during the pandemic, we really kept cash very tight. So our capital spend during that period was as low as 2 million in the full year. So there is an element of catch up here. We do have to reinvest back in the fleet, and that is what we're doing, and that's why we're expecting a significant spend on capital. In terms of M&A, look, we are constrained by we have a healthy balance sheet with a healthy cash balance and an 11 million funding facility that we could draw. Clearly, that sort of 20 million-ish headroom doesn't allow us to go mad with M&A activity, but the sorts of levels of M&A spend, as an example, Rock and Alluvium 3.8 million. I think with the cash flow generation and low debt, we should be able to be looking at sort of one of those per year. But clearly, we're not in the game of going on taking huge amounts of debt to the business and putting us at risk.
And if maybe I can add before you start, Mark, maybe I can just add Marcus's question, which plays into this a little bit, which is, how do you see further geographic expansion of the group playing out? That might be an element to this too.
Yeah, right. So Graham's quite right. Probably one bolt-on per annum feels about right. What size should a bolt-on be? Well, probably 3-4 million. It feels about the right size. With the bandwidth issue as well for the management team, without creating a whole new sort of overhead stream. But we've learned a lot from Screwfast and Rock and Alluvium, and in fact we're the only player in the industry that's doing any consolidation at the moment. So people do realise that, and it brings some opportunities that we might not have been aware of otherwise. But we would need to be selective. There aren't many niche capabilities we haven't already got, and there aren't many, to your point, geographical regions where we feel we need to make an acquisition to strengthen London as a little bit of an outlier in that respect, because it's a market within it of its own, really, in some respects. Internationally, are we likely to do anything else other than Canada? No, I don't think we are. I think we need to get Canada where we want it, which we're focused on, and take full benefit from all the efforts and investment we've put into it so far. Certainly, even sort of 6 months down the line, we haven't found a region that's got more opportunity than Canada, that's for sure. So I don't think we'll be distracting ourselves other than getting full benefit from what we're doing out there internationally. So I don't know if that really answers much, but regionally, I think we're well covered. We literally the UK. There's possibly some strengthening we could do in Scotland, but at the end of the day, Scotland's a relatively small market compared to the rest of the UK. We'll see. I think it's more likely to be an additional service offering that might not be a niche area, but it allows us to widen our services faster than growing it organically. And our civil engineering division is a good example of how we feel we could scale up even more quickly than constraining ourselves only to piling and geotechnical work. Would that be an area of potential acquisition? Yes, it could be, but the right sort of thing would need to come along.
Great, super. All right, final question. Could you please provide some colour on the bridge between today's margins and medium-term targets?
I'll take that one, Mark, if you like.
Yeah.
I mean, there's clearly a lot of detail in there from our internal modelling to get from where we are, which we've demonstrated a gradual improvement over the last 2 to 3 years. The big factor here, without oversimplifying the answer, is that it's about getting the high quality niche skill set that we have in the infrastructure sector, which typically delivers at the upper end of our margin range. And as that, to Mark's points and slides that he talked through there in the power and water sector, as that work comes through and as we have a better mix impact of that higher margin work, that effectively bridges a large slice of the gap between where we're at now, which is just short of 4%, up to our target of 6%. Of course, within there's lots of other activities. I mean, maybe additional bolt-ons, delivering niche skill sets. We're looking at cost efficiencies across the board. We're looking at efficiencies in our systems to become a better, quicker business. And of course, in housing, although we sometimes talk about it being at the lower end of our margin range, when it is firing and it is busy, the costs of operation are relatively low. So it's very attractive towards our return on capital. It doesn't employ significant cost of high value rigs, complex works, and obviously we've got a manufacturing facility for SmartFoot. So when it's working and when it's busy, that gives a very good throughput to the bottom line.
Great, super. Mark, anything to add to that, or is that complete?
I mean, top line growth will make a big difference as well. We tend to do it very, very well when we've got high utilization, and compounded by the mix around the margins, that creates quite an exciting cocktail. So that's where it comes from.
Great, super. All right, thank you both. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Van ELLE, please do get in contact via vanelle@walbrookpr.com. Many thanks for attending today's presentation.